Great to be here. My name is Paul Tostwin. I'm a director of World Research. I'm based in London. And obviously this year has been a very different year. We've seen significant change to our established way of life. And the pandemic's really altered the face of global property markets. But not all real estate sectors have felt this impact equally. Certainly branded residences have proved to be a relative bright spot and more resilient than perhaps some other sectors. Now, in a moment, I'll start by running through the highlights of our latest research on branded residences. I'll take you through the sector's growth, its global diversification, price premiums, as well as some trends and prospects for the future. And at that point, I'll open up to our panel discussion, where we'll delve further into the topic from both a global and Middle East perspective. And you're welcome to submit questions into the chat function throughout my presentation, and we'll aim to pick some of those up in the panel discussion. So first thing, I think it's worth stating exactly what we are talking about here. So a branded residence is a residential property sold on the open market that's affiliated to a well-known brand. So we're not talking about service departments, which are much closer to a hotel product, although it is of course possible for individual owners to rent out their branded property. So branded residences are a formula that works, and the affiliation of a brand to a residential property has really fueled the growth of the sector in the last decade. There are more than 500 open and operating schemes today, with more than 76,000 units between them. The number of schemes has actually grown by 170% over the last 10 years, and 2020 is set to be another record year with over 100 schemes opening. And with this growth in mind, we're seeing more and more brands participate in the sector. And the number of those brands has actually doubled, more than doubled in the last 10 years, from about 60 back in 2010 to 130 in 2020. And that's forecast to reach nearly 160 by 2025. And that growing global participation has brought ever greater global spread. And what started as a very urban, US-focused phenomenon has really moved to reach every part of the globe. Cities of all sizes, increasingly resort settings, across, as I say, across the world, and of course, increasingly in the Middle East too. Now, this chart shows the distribution of branded residential developments over time from a geographical perspective. Now, back in the 1980s, when the sector was still in its infancy, the US accounted for all global stock. Indeed, North America was home to half of all schemes right up until 2015. This red dotted line shows that half share. North America, US currently accounts for 40% of completed schemes. What we've seen, though, is massive geographic diversification at play, driven in particular by Asia Pacific. That's the blue wedge. Asia Pac now accounts for a quarter of all pipeline schemes. That's followed by the Middle East and North Africa with 20%, Europe with 17%, and just 16% of pipeline now in North America. So a real sort of switch of distribution, if you like. It's interesting, though, to look at the same chart, but this time on a country level, and you can really see that growth in Asia Pacific has been led by particular countries, notably China and Thailand. Middle East has grown very rapidly too, and that's been led by Dubai, and you can see the UAE here in purple. This really comes as the demand base is broadening. I think a good example here is Thailand. It taps into both growing domestic wealth in cities such as Bangkok, but also resort settings. So Phuket, for example, now one of the biggest centers for branded residential in the world. And that's thanks in part to its position as a global tourism hub. Now, putting those complete schemes onto a map and starting to look at this from a city level, we see the dominance of three particular locations. That's Miami, Dubai, and New York. The cities with the largest number of schemes today. They've got 32 29 and 25 schemes respectively. And that, though, is going to change. Now, this map now shows pipeline, and Dubai has a pipeline not far off the number of existing schemes it currently has in terms of branded residential. That will push it into first place. What's really interesting, though, are those locations that are adding a large number of new branded residential developments, specifically countries adding at least 50% to their existing supply base. So North and Central America, fast-growing markets, Mexico, Belize, Costa Rica, all big resort destination markets, very strong with US buyers in particular. Lots of growth to come in North Africa and the Middle East, a region, of course, with very fast-growing domestic wealth. So Morocco, Egypt, Bahrain, Saudi Arabia, and of course the UAE, all adding a lot of schemes. Over in Asia Pacific, Malaysia and Vietnam following in the footsteps of Thailand and Indonesia. The growth isn't all coming from emerging markets. We're seeing brands expanding rapidly in the UK, in Spain, and Australia, among others. And in these cases, really targeting those sort of international gateway cities of London, Barcelona, and Sydney, among others. Now, one reason for the sustained growth the sector has seen is the premiums that can be achieved on branded residential property. Our research shows on average a 31% price premium over equivalent non-branded properties. This, though, varies significantly by location. This map shows exactly that, the distribution of price premiums by city. Now, broadly speaking, higher premiums are achieved in emerging markets where typically prime markets are less developed as a whole, and branded product kind of goes in, sets a new benchmark. And we've actually seen premiums exceed 100% in places like Belgrade and Almaty, and you can see that on the map here. Premiums generally are at the lower end of the spectrum in prime markets that are most mature, so London, Singapore. In New York, actually, we've seen on average a negative premium, and that's really because of some exceptional non-branded products in that city. Some mature markets with very wide international appeal, though, the likes of Miami, Dubai, can still command higher premiums on average around the 30% mark. And really that comes down to very, very highly international purchaser bases, a lot of wealth from emerging markets in particular. I would say brand alone doesn't guarantee success. In some markets, brands have been used to attract interest in schemes in fringe prime locations, but location does still matter. And actually there's been evidence of slow sales rates in some such schemes where the units themselves aren't market driven or overly reliant on the brand power alone. So there are still other factors at play. So what's particularly interesting is to understand who the main players in the sector are and how they've changed over time. And we've got a lot of data on this, and we've mapped that progression. So back in right back in the year 2000, the biggest brand globally was Trump, Donald Trump's own brand. And at the time, of course, the sector was a fraction of its current size. Look then at the evolution of the brand league to the present day. Marriott has been the top spot ever since the year 2002. Currently has a circa 21% market share, by far the biggest player in the sector. Second place is a design-led non-hotelier brand that accounts for 12% of the number of projects globally today. They're followed by Four Seasons, Hilton, and Trump, equal fourth, and Accor in sixth place. Now, looking ahead to both complete and then adding in pipeline, we get a sort of view to the future of where the league is going to look in the years to come. Marriott retains the top spot. Accor, though, really jumping from sixth place to second. Very sort of formidable pipeline of projects coming forward from them, followed by Four Seasons, Hilton, Trump, and we see Hyatt and IHG in particular steadily rising. You know, all this changes is really testament to the potential the sector offers, and you know, the big brands are responding accordingly. So with all these new brands entering the market, there's real opportunity outside of the luxury segment in particular. So namely upper upscale and mid-scale brands as they're defined by the hotel chain scales. So non-luxury brands today currently account for 23% of open and operating schemes. However, this segment's set to grow fast, and actually based on pipeline, they account for 31% of all future schemes. What are these brands? Well, they're led by Westin, a Marriott brand, and Hilton. And the biggest upper upscale brands, sort of others also include Swissôtel, M Gallery, and the core brand, Autograph Collection, another Marriott brand, and Vida from MR. And I think it's worth sort of considering how this, again, is sort of fueling the sort of geographic growth of the sector. And actually the deployment of these brands is a little different to what we're seeing in the luxury segment. And that's really helping to open up those new markets. Now, North America accounts for 43% of completed non-luxury schemes globally, but that is set to change. And actually it's Asia Pacific, which is going to become the biggest reason for the non-luxury segment based on pipeline. Now, this chart shows a selection of countries by their distribution of chain scales based on both complete and pipeline schemes. On the left-hand side, you've got the likes of UK and Mexico, much more luxury brand dominated. But interesting, as you go further east geographically, you see a greater diversification of chain scales. And I guess to the most extreme example in sort of Thailand and Vietnam, actually non-luxury brands account for almost half of complete and pipeline schemes. And again, this kind of comes back to the fact that these are emerging destinations that have both deep tourist markets, so tapping into plenty of sort of second home buyers, but also are able to sort of tap into that growing domestic wealth demand base. And finally, a word on cars, fashion, and design. So while hoteliers dominate the sector, they're not the only players. And a really interesting thread is the emergence of sort of an ever wider range of other types of brand. And these include car, fashion, and design brands. So over the last 10 years, the growth of such schemes has actually outpaced that of hoteliers, rising from 11% of the total market in 2010 to 16% in 2020. Now, this chart shows the composition of those non-hotelier brands based on complete and pipeline schemes. And you can see the types of these brands is diversifying. So fashion and automotive in particular are leading. Interestingly, food and beverage there in green, just the one project by Nobu. And we'll pick that up actually in the panel. I think it's an interesting thread. And then kind of looking ahead as to sort of what these brands actually look like, I've highlighted a few here that represent completely new brands entering the sector, so new pipeline projects. And they're as diverse as Pharrell Williams and Aston Martin. So I think really testament to the sort of the long-term scope that we see in the sector. So that concludes my brief overview of the research, and in a moment I'll ask my panelists to turn on their cameras, but just to introduce them, I'm about to be joined by Jaidev Menezes. He's Vice President of Mixed-Use Development for Marriott International in the Middle East and North Africa. Rian Atani, he's Head of Savills International Development Consultancy. He and his team are also instrumental in the research I just outlined to you all. And Richard Poole, Head of Professional Services and Consultancy in the Middle East for Savills, and he's based in Dubai. So I will ask my panelists to turn on their videos at this point. I'll stop sharing. So welcome to you all. And yes, a reminder to our audience, please do add your questions into the chat function at the bottom of your screen. Jaidev, I'll start with you. As we've heard, Marriott are the biggest player in the sector globally, so it's great to have you here. I'd be interested to understand sort of what's Marriott's rationale for participating in the sector, and interested to hear sort of why Marriott are a good brand to buy into or partner with.
Sure, thanks, Paul. I guess two parts to that question. The first being the rationale for us, why we look at the space. For us, it starts with the consumer. We know that today's most valuable real estate buyers are looking for the level of services and amenities that you typically, or that they typically get in hotels and resorts around the world. And we're able to translate that from a hotel and resort environment into a branded residential environment. So that's predominantly why this space is interesting for us. The second part, in terms of why Marriott, I mean, we've been in the business for more than 20 years on the branded residential side, clearly starting with Ritz-Carlton residences in North America. The group today is the world's largest branded resi operator and licensor of brands. We've got an incredible portfolio of hotel brands. On the residential side in particular, we focus on 15 of the 30 brands, about 7, 8 in the luxury space, including St. Regis, Ritz-Carlton, W, Edition. And on the premium side, obviously Westin, Marriott, Sheraton, Le Méridien, those brands. So we've got a good portfolio of brands. We obviously operate 101 projects, branded residential projects globally, with another 82 in the pipeline. The Middle East, Africa region, we operate 14 with another, I think, 30 in the pipeline. And we've got a strong operations track record as well.
So yeah, interesting to hear. And I guess, Rich, sort of pivoting to you and thinking a bit about the Middle East and I guess Dubai specifically, we heard a bit about the quite strong pipeline coming through of branded product in the UAE and in Dubai. How is demand for branded residences in the region, and how do developers and investors perceive it?
I think brands have always resonated with a Middle East market, particularly in Dubai, and not just hotel brands, but all manner of brands and brand associations. I mean, when I first arrived in Dubai, brand affiliation or association, not just with hotel brands, but also with celebrities and things of such like, were prominent, and they were in the pipeline. And I think Dubai and some of the developers jumped on that bandwagon at the time. Now, unfortunately, the global financial crisis came in 08, and a lot of those fell by the wayside. But you could see that clearly there was an initial excitement and demand of getting those sort of names or affiliations as part of your real estate. Now, as you've rightly said, the supply pipeline and the current inventory that is out there is quite vast, and a lot of developers look to perhaps use a brand as a differentiator for their product, hoping for a solution to extra value or faster absorption, which is not always the case, as you alluded to in your presentation. So we actually, in terms of how the Middle East or Dubai market or the GCC perceives brands all differently. So we carried out quite a large survey around this time last year, speaking to high net worths and ultra high net worths within the region about which brands they resonate with. And it was very interesting, depending on which countries are in, brands resonate in different ways. People perceive them as, yes, that's something that I can associate with extra service and therefore happy to pay extra value, and others not so much. And so, if you are a developer and you are looking to engage with a brand, you need to do that due diligence ahead of time to really understand what your customer resonates with, wants to be affiliated with, before you agree to any sort of agreement.
And actually some great questions coming through from our audience. I think this could be a good one for you, Rian, a sort of technical one. Do timeshare and fractional ownership products fall into branded residences?
So, I mean, technically speaking, yes, they are branded residences, but they don't fall into our definition of branded residences. So timeshare, fractional, service departments, none of those fall within our statistical analysis. So we're looking primarily or predominantly at freehold properties or long leasehold properties which are available to sell at an individual unit level. And that's really the market that we're interested in studying at this level of detail, albeit that the serviced and longer stay markets do form an important part of the industry.
Thank you. And a question here, which Richard sort of started to touch on. Appreciate if you could give some colour to the nationality profile and motivation behind purchases of branded residences in the Middle East and Saudi Arabia. Rich, maybe you might start. Maybe Jaidev, I don't know if you've got any perspectives on this.
Yeah, I mean, the study was vigorous, and some of the results are with us. We haven't necessarily published all those results as yet, but it's something that we can do with clients. We can show them exactly the feedback of those high net worths and those Saudi potential buyers, their comments on those brands. But it's interesting to some of the takeaways was that it differed depending if you were talking to a high net worth individual based in Dubai or in Abu Dhabi or Qatar or in Saudi Arabia, and understanding those different points is really useful when you're putting a concept together and you're looking out into a market to which brand you should associate yourself with. So, without sort of naming anyone necessarily in particular, it is your usual suspects in terms of some of the hotel brands, more so the hotel brands, less the fashion brands, and less the lifestyle brands. Right. But also the dynamics of perhaps the age profiles, which was interesting when we surveyed them. The age profiles within the Saudi market all like different things as well. So, you've got to think about, depending on the size of your project, you've got to think, when are we coming to market with this, and what are the buyer profiles going to be like in 5 years or 10 years time? Because the brand associations, what they feel that they resonate with, are going to be different from what they are now, or certainly what they have been 5 years ago.
Mm-hmm. And Jaidev, is there anything you can add from a sort of hotelier perspective?
I think just one thing to add, I think we've seen a sort of global trend, especially with COVID over the last 9 months, where, and we don't know yet whether it's a trend or not, but it's something we're watching. We're finding a lot more demand for people who want to live in their units year round. As their primary home versus participating in either short or long-term rental. Now, the Middle East obviously is almost 70-30, I would guess, investor driven on the residential side versus primary use. So I'm not sure how that translates here, but globally, we're seeing this in the US, we're seeing it in Asia, we're seeing it more and more in Europe, where people are buying second homes. They want second, third, fourth homes, and they're not letting them out or renting them out like they were before.
Okay.
So that's something that we picked up this year.
Interesting, thank you. I quite a few questions come through, so I should add that we will aim to get back to people directly if we don't cover everything in today's panel. Question to you, Rian, I guess about sort of the scope of the sector, and although we've seen huge sort of influx of new brands and new hoteliers, I guess there are still some absences. Sort of why perhaps are we seeing some absent, or how far do you think it can all go ultimately? I guess is perhaps the question here.
In terms of the hoteliers coming into the market, or
yes,
or generally
hoteliers.
Well, I think in terms of hoteliers, the thing you have to bear in mind is that branded residential isn't their core business, or at least it hasn't been historically. So brands, generally speaking, are more reticent to get into managing residential properties, managing the HOA budgets, making sure that the schemes are developed, sold, and managed to brand standards. So it is a step to take, let's say, for operators to get into the sector. However, and you'll appreciate I spend a lot of my professional life thinking about which brands can come into this sector and which ones are going to resonate best. And the fact is that hoteliers dominate the market for the simple reason that they understand how to manage residential or dormitory spaces. So, and that's quite aside from all the facilities and amenities that they can provide. So they are the de facto experts in this kind of field. So with the development of a residential team, and so many of our clients, whether it's Rosewood, Hyatt, even Accor, are developing and expanding their residential teams to focus more in on this market. And that's not just residences next to hotels, that's standalone properties, which are becoming just increasingly more important in terms of being able to spread the brand values, but also taking what would be called an asset light approach to the development. So they're coming in, they're branding residential products, but they're not actually running and servicing a hotel facility as well on site. So where can the industry go? I feel like we're really just at the beginning of it in terms of geographical coverage, in terms of the numbers of brands coming into the market. We're seeing huge expansion in the non-hotelier segment. We're seeing 34 new hotel brands coming in the next 4 to 5 years, another new 11 lifestyle brands. So I think there's a huge way to go.
A couple of our questions sort of are touching on sort of operations and the sort of sales environment in 2020, which obviously is a very exceptional year. And given COVID-19, I guess sort of framed in that context, question to you, Jaidev. I mean, what are buyers' expectations for from a branded residence, and how do you ensure consistency across countries and brands, and how has COVID sort of changed that, if you like?
Yeah, I think, especially for a company our size with these, with multiple brands, it's critical, and we do it on the hotel side as well as on the residential side. Every brand swims in its own swim lane, from a physical design aspect, as well as, from a soft services and the guest experience, right? So we find that, but at least we have to be able to keep the brands differentiated. And I think a couple of trends that have, again, come out during COVID. This year has been pretty interesting, actually. Clearly, on the hotel side, there's an unprecedented impact on our hotel business. It's good that things are starting to look better. But on the residential side, I think this is probably the busiest we've ever been globally. There are still a lot of opportunities, despite markets being rocky, especially this part of the world. There are opportunities for brands, and the space is large enough, like you said, Rian. I mean, both on the hotel side, looking at fashion brands, lifestyle brands, etc., where purchasers, end of the day, are looking for a stamp of approval. They're looking for facility management, property management, and a certain level of services. And they're looking for some sort of asset protection in the long term, right? And brands, if you look at most of the branded buildings, take Dubai, for example, I would argue that, if the markets have fallen 35% since the peak in 2014. I would argue that that fall has probably been less for buildings that have been branded because of the way, they've been maintained over that period.
And Rich or Rian, any sort of anything to add to that in terms of how you see sort of COVID changing the market this year, or perhaps it hasn't?
Yeah, I just wanted to add a little bit to JD's point, which was that there is a resilience within branded residential property, also because of the fact that the purchasers of branded residential property are less finance driven. So by virtue of when you're in a financial crisis or any kind of economic crisis, there is more resilience in this level of the market, which is often why you see in financial crises the prime central markets responding slower or getting affected slower, because effectively they don't have to raise finance in order to purchase their property. So there is a kind of an inbuilt resilience that's in there. I think the other thing to point out is that management is a key element to this model, and it's often, I get often asked, when does it go wrong? What are the things that we should avoid? And often it's about mixing the location and the brand, and those two things not resonating. The location also encompassing the nature of the buyer markets that are inherent there. But also it's about thinking that putting a brand on a building is going to sell it. And the fact is that a lot of this is about the quality of the service and management of the properties on an ongoing basis. And that's what enables it to hold its value. And, Marriott, Accor, Hyatt are the masters of that type of trade.
Richard, anything to add on that?
Yeah, I just want to reiterate the fact that particularly this year, with lockdowns being put in place all around the world, people have spent more time in their properties and have noticed perhaps that the FM and the PM of those buildings that they reside in, whether they lease them or own, perhaps aren't up to scratch. And I think it gives people the confidence, whether it's got a Savills badge at the bottom of a building because it's managed by them, or a Marriott badge who are looking after the residents, that people feel comfortable with living there. And I think actually, particularly in Dubai, the hotels did open up pretty much to domestic users over the summer, and hugely impressed with how they've been operated and looked after, and how the comfort levels of people feel when they're in them. And I think that will do them favors in the long run in terms of how then they perform. And as Rian says, it's that kind of after sale maintenance and looking after their properties that they then go, well, actually, this is why we do it, not necessarily just because that there is a brand stamped on there. It's everything after the sale.
Mm-hmm. Now, a big thread in our research, and actually a question here sort of asking more on this, is sort of price premiums and sort of, I guess, the variation around those, and actually how that relates both to, as well, sort of revenues and costs. I mean, Rian, do you want to unpack the sort of premium story a bit more?
Sure. Again, this is a big polemic that comes out of our research, in particular the discount or the negative brand premiums that you see in very established and highly competitive markets like New York. I think what's important to note is that a lot of this is a game of statistics. So you have to look at what the premium is and how it's being calculated and generated. So in an individual market, so let's take New York as the example, there is even within that market a strong variation in terms of brand premiums. So if you look at, for example, the Mandarin Oriental in Columbus Circus, you're looking at a brand premium of over 50%. Or if you look at the Four Seasons, it's about 45%. And that's a positive 45% premium, which is a huge premium. It's a great branded residential premium to achieve in almost any market. But then you also have, and apologies in advance for the coincidence, but you also have 8 Trump properties in New York, all of which trade at between 19 and 50, 60% discount to the market. And why? Because they're located in close proximity to 432 Park Avenue, which is one of the best residential buildings in the world, non-branded, but is achieving like $64,000 per square meter. So effectively, those branded projects don't stand a chance. These are different projects released at different times. So I think the point I'm trying to make is that whilst a global brand discount is sometimes seen in these markets, the reality is that there are some really strong premiums that are achieved within those markets. And actually, we're looking at, there are 23 branded projects in New York. So there's a big statistical pot in branded terms to mask those variations. What I would say, however, is that brand premium is driven by many different factors. It's not just the brand. The brand is extremely important, but location, services, amenities, accessibility to key facilities in that city or in that resort area equally weigh into it. The reality is that, and my team did a study this year looking at actually specifically at lifestyle branded, so non-hotelier branded residential properties all around the world. And we studied just over 60 of them in close detail, looking at the premiums that they achieved. And in particular, how those premiums relate to the cost of developing those properties. And we found that almost exclusively the net profit margin from developing branded residential is much, much higher than the net profit margin of developing non-branded residential. So as long as you marry the location to the brand and you understand the type of purchasers who are going to come and buy into that project, which is what my team does all around the world, advising developers on what is the right brand, who's going to come and buy these properties, and what should they be like, then the premiums are relatively easily achievable. And sorry, I know I'm going on, but just to be clear, premium is relative to also to factors like absorption rate. So you can achieve a huge brand premium, but you can expect your sales rate to be potentially quite low, or you can achieve a very low brand premium. A great example is the Nobu in Toronto, which priced itself at only 5% above the local market, so a very small brand premium, but they sold 400 units in 3 months. An absolutely incredible rate of sale. So these two things are relative, and our job is generally to try to find that optimal point for any given market. But the point is that if you put in the good brand, the right brand, and a great level of servicing, then a brand premium is close to inevitable.
A lot of factors at play there. Very, very interesting. A couple of questions coming through around.
I think Rich wanted to say something.
I'll just add to that, Paul, if I may, and it just to echo that there are plenty of examples in the Dubai market and around the region where that initial sort of SWOT analysis of the site initially hasn't been done, or certainly hasn't been done independently, and as a result, if, as Rian said, if your location and the variables that affect initial stages of your development, so the views it offers, the perceived desirability of that area, the amenities nearby, the transport links, the unique offering of that site, whether it's water, beach, marinas, whatever vista, if it doesn't score well in all of those points, then perhaps don't even consider a branded residence. It has to be scoring in my view, particularly in Dubai, at those with all of those initial variables first, to even consider going down a branded route. And you look at some of the success stories within branded residence within the UAE. You've got sort of St. Regis in Abu Dhabi, Bulgari residence, Amani residence. The growth and popularity of the Address brand and the Vida brands, they've all got one thing in common, is that they are very uniquely positioned developments that benefit from all of those things that I talked about. And if you have a neighboring scheme that is slightly adjacent, that doesn't quite have that frontage or doesn't quite have that location, you're not going to get the premium, and you might be paying quite high agency or fee rate to that brand, but you're not going to get it. And unfortunately, there are a lot of other examples of sort of secondary locations where the spec and the visuals of the product is lovely, and the brand is a well perceived brand, but because of those primary variables aren't quite right, the absorption has been poor. Generally, it's been overpriced. So you've got to get all of these things right, as Rian said, ahead of time before you then consider a brand.
Joanna, did you want to add anything on that, or more about kind of what makes a good location generally?
I think we've touched on location. I think for us, the way the other important variable for us obviously is our partner on the deal. I mean, So we look to the strength of the developer. We look, obviously, they need to have a proven track record in the market. We look at their sales, their past sales, ability to sell out and deliver, more importantly, especially in this region. So that's the only other thing that we would look at when we evaluate a branded residential project.
A couple of questions coming through around sort of tech innovations and how that's shaping resident experience, and I guess broadening that in terms of innovative trends that we're seeing in branded residences generally, and indeed how they might be applied within the Middle East. Interested to hear any views on that, sort of best practice or tech innovations that are playing out that could be applied in other places.
I think if I can jump in there, actually what that question highlights for me is more of an omission rather than a presence, which is that certainly from a brand perspective, the tech industry is woefully unrepresented in branded residential, which there's a lot of conversation around that about why that is and whether the tech industries are too sort of ever present in people's pockets, so they doesn't hold enough of a kind of luxury cachet in order to brand up well. On the other hand, we rely on and use technology probably more than any other sort of means of communication. So I'm surprised that it's not there. Now, on the other side, in terms of what is being put into properties right now, we've seen some innovative things. We've seen the use of contactless systems in order to deal with concierge and booking of facilities within a building. We've also seen effectively things like negative pressure air systems and air filtration systems using UVC in the Middle East, which is a direct response to COVID and air pollution. And I think things like that and an increasing importance on the support facilities around health and wellness are going to be things that we see going forward.
Great. I guess Joydev, actually coming back to you in terms of Marriott's sort of plans within the region, would be interested to hear about your sort of views on countries that Marriott's likely to be very active in the coming years based on your pipeline or otherwise.
Yeah, just to say, our existing portfolio is about 14 operating projects with another 27 in the pipeline across Middle East and Africa. I'd say country-wise, the usual suspects, obviously Saudi, we're involved in a number of the giga projects, and some interesting private developments, both in Riyadh and Jeddah at the moment. The UAE continues, obviously. Dubai, we've got a number of conversations going, pretty active. Abu Dhabi too. We're seeing also interest in some of the other Emirates, Ras Al Khaimah, for example, more for some of the upper upscale brands and the traditional luxury brands. And Oman and Bahrain to a lesser extent, but I would say the UAE, KSA, and Oman. In the Middle East, Africa, obviously, Egypt, Morocco, we're seeing a lot of activity.
Very interesting. Conscious of time, so perhaps sort of one last sort of forward-looking question to you all. I guess really around sort of how far do you think you sort of see this sector going? I mean, Rian's touched a bit on some of the gaps in technology companies. Would be interested to hear your views on sort of where is saturation for this sector.
Happy to go first on that. For me, and obviously I'll try and get it in a couple of minutes, but I don't think it can be just one brand, and I think you've already started to see that. There's numerous brands that can play a part in the marketability and the value of your asset, apartment assets perhaps. As we said, the F&B, the retail, all of those things are really crucial to the success of your scheme. In terms of how it could go, yes, the tech companies are, clearly just again talking about the demographics and of the buyers market at the moment. The youth of today resonate far more with the Teslas, the Apples, and the Googles than they might do necessarily with the Aston Martins or the Louis Vuittons of the world. So, that's how it's going to go. Clearly in Dubai at the moment, which is really interesting, is that there is a demand uptick in villas away from self-confined apartment living. And we haven't really seen a huge amounts of branded residence on villas, and other than around golf courses, perhaps. So I could probably see a bit of a growth in that, and that's maybe something to think about in sort of short term.
Joydev, any final thoughts?
I think two things. One is we've seen an increased demand for the upper upscale brands. So, for example, Westin, Marriott, Sheraton, Le Méridien, which has come out pretty substantially, especially in the last 24 months, and globally. And the other really interesting thing for us is where we're doing a lot more standalone branded residential projects. So not co-located with the hotel, but standalone. We have a JW and a Marriott residences in Cairo. We signed a W and a St. Regis in Cairo last year. So we're seeing a lot more interest for doing standalone branded residences. And I think the other thing we're seeing is, and more this year than last year, is we are in discussions with our hotel owners on, owners who own, say, a 300, 350, 400 key big box, upper upscale luxury hotels who want to extract value from the asset, right? Especially with COVID, rates and occupancies have been hammered. Hotel owners are under pressure. And so we're in discussions in a number of different markets to see if there are ways to carve out the hotel space, strata title some of the suites, or convert some of the upper floors to a branded residential play. So that's another thing that that's also come out recently.
Fascinating, thank you. And Rian, any final sort of forward-looking thoughts?
I think without getting too sort of philosophical about it, branded residential is effectively a way for an individual buyer to have certain elements and aspects of their built-in environment managed for them. And as I said before, the hoteliers are the natural fit for that. But the direction of travel is that we are seeing more upper upscale and lower chain scale brands coming into the market. And we're seeing at the same time different types of lifestyle brands coming into the market. So I think the advent of food is a very interesting element of this, and again is very unrepresented, with only Nobu in there. And again, Nobu at a Michelin starred kind of level. So I have mentioned in the past in interviews and so on, the kind of the democratization of branded residential. And I think that whilst that is a bit of a stretch, I think the movement of travel is that more people will be buying into this type of lifestyle, because increasingly it will become more accessible to more people, whether that's purely at a geographical basis as the industry spreads, but I think probably more responsively, in the sense that people want these elements of lifestyle and service in their lives, and operators would be canny to figure out that there is a lot of buying power at other elements of the market as opposed to just luxury.
Interesting. Well, thank you to all. I think we'll draw it to a close there, and so thank you to our panelists for a very interesting discussion, and thank you to all of you for joining. This is part of a series of webinars started in the summer, and you'll be sent the relevant page and a recording of this webinar as well. And do look out for more of these in the months ahead. And thank you, and have a good day.
Thank you.